In my last video, I explained how Fannie Mae and Freddie Mac approves mortgages using automated underwriting systems like Desktop Underwriter and Loan Product Advisor. But today, we're going to talk about something even more important. How do you actually get an approved eligible result from DU? Because here's the reality most homebuyers don't understand. Mortgage approval isn't random, and it's not just about having a good credit score. It's about how your loan is structured inside the automated underwriting system. In this video, I'm going to show you the 5 factors DU cares about the most, the compensating factors that increases your approval odds, and how loan officers structure loans to pass automated underwriting, and the simple changes that can turn a refer into an approved eligible. If you're planning to buy a home, refinance, or just want to understand how lenders think, this video will give you the blueprint. First, let's talk about what Desktop Underwriter is really trying to do. DU is analyzing one thing: risk. It looks at millions of past mortgages and tries to answer a simple question: how likely is this borrower to repay the loan? To determine that, DU analyzes what the mortgage industry calls risk layers. Risk layers include things like credit score, debt to income ratio, loan to value ratio, occupancy type, property types, cash reserves, and payment shock. The more risk layers a loan has, the harder it is to get an approval. The goal is to reduce risk in one area if another area is weaker. There are 5 factors that influence automated approvals more than anything else. If you improve these 5 areas, your approval chances increases dramatically. Number 1, credit score. Credit score is one of the most powerful approval factors. Higher scores tell the system the borrower has a strong repayment history. Here's generally how the system views credit tiers: 760 and above, lower risk category; 720 to 759, very strong approval odds; 680 to 719, still solid for conventional loans; 620 to 679, approvals become more sensitive to other factors. Below 620, conventional approvals become difficult. Now, this doesn't mean you need perfect credit. What matters is how the rest of the file compensates for it. 2, debt to income ratio. Your debt to income ratio, or DTI, measures how much of your income is going towards your debt. This includes mortgage payment, credit cards, car loans, student loans, personal loans. Most conventional loans try to stay around 45% DTI or lower, although DU can approve loans higher depending on other strengths. Lower debt equals lower risk, and lower risk increases approval odds. 3, loan to value ratio. Loan to value measures how much you're borrowing compared to the property value. Example, if you're buying a $500,000 home with 5% down, your loan to value is 95%. Higher loan to value loans mean less borrower equity. Less equity equals higher risk. That's why approvals become easier when borrowers put more money down. Example, 20% down loans are easier to approve than 3% loans. 4, assets and reserves. One factor many buyers overlook is cash reserves. Reserves are funds remaining after closing. These funds prove that borrowers can continue making payments if income changes. Reserves are typically measured in months of mortgage payments. For example, 3 months of reserves, 6 months, 12 months. The more reserves you have, the stronger the file looks to DU. 5, stability of income. DU also evaluates how stable and predictable your income is. For example, a W-2 salaried income is considered the most stable. Hourly income is also strong if the hours are consistent. Self-employment can require more documentation because income may fluctuate. The more stable the income history, the lower the perceived risk. One of the biggest misconceptions about mortgage approvals is that all numbers must be perfect. That's not how automated underwriting works. DU looks at the entire risk profile together. For example, a borrower with a 660 credit score but has a 25% down payment and low debt and strong reserves may be approved easily, while another borrower with a 760 credit score but extremely high debt to income ratio may get a refer result. The system balances strengths and weaknesses across the entire file. Experienced loan officers like myself know that sometimes a loan needs to be restructured to get approved. Here are the most common adjustments. Reduced debt. Paying off a credit card or car loan can dramatically lower the debt to income ratio. Sometimes eliminating just one monthly payment can turn a refer into an approve. Increase the down payment. Even small increases in down payment can help. Example, moving from 3% down to 5% down can improve risk layering. Add a co-borrower. Adding another income earner can reduce the overall debt to ratio. This strengthens the file immediately. Correct income calculations. Sometimes income was simply calculated incorrectly. Recalculating income based on correct documentation can change the system result. Change loan program. Occasionally, switching programs can help. For example, from conventional to FHA, or from Freddie Mac LP to Fannie Mae DU. Each system evaluates risk slightly differently. Now let's talk about the biggest mistakes borrowers make during the process. These mistakes can take a loan from approve to refer overnight. Opening new credit increases monthly debt and lower credit scores. This can change the entire approval profile. Buying a car before closing. Car loans are one of the biggest approval killers. They dramatically increase debt to income ratios. Large bank deposits without documentation. Unexplained deposits can trigger underwriting issues. All funds used for the transaction must be sourced. Changing jobs. Income stability is critical. Changing jobs during the loan process can require a complete reevaluation. Here's something most buyers never realize. Mortgage approvals are often about strategy and preparation. If borrowers prepare 3 to 6 months before applying, they can dramatically increase their approval odds. This might include paying down credit cards, improving credit scores, building cash reserves, avoiding new debt, stabilizing income history. Small changes ahead of time can make a massive difference when the loan is run through DU. Getting a DU approved eligible result isn't about luck. It's about understanding how the automated underwriting system evaluates risk. The strongest approvals usually come from borrowers who have stable income, manageable debt, solid credit, some financial reserves, and a well-structured loan application. When those factors line up, the automated underwriting system does exactly what it's designed to do: approve the loan. If you're planning to buy a home and want to know what your loan would look like through DU, reach out and I can run a scenario for you. And if you want more breakdowns on how mortgage approvals actually work behind the scenes, make sure to subscribe for more mortgage education.